Hey, happy Sunday. I hope everyone is doing well. I'm back in the saddle here. Had a bit of travel the last week or so. But, there's a lot happening out there in the world. And I want to share some of the things I've been learning. I've been doing some short clips on Twitter. You can take a look at those over the last few weeks. But I want to touch on a few things here. Um, One is stable coins I keep coming back to again and again. Um, you know, my main thesis here is that you're going to see some large right tail outcomes for bank infrastructure players in this category. Today I learned that there are 200 fintechs lining up for an OCC charter. The OCC is the regulator for national banks. If you have an OCC charter, you have preemption. It means you can operate in all 50 states. You don't need state by state licensing. So this idea of digital assets and fintech and banks, they're colliding upon one another. Um, I think a big irony of all of this is that I think a small number of well-positioned infrastructure banks can do really well, meaning the picks and shovels layer that underpins those fintechs, many of whom will not be able to get an OCC charter. And there are thousands of others that aren't even intending to. So that's one thesis. You can take a look at a video I posted a few days ago if you want to kind of double click into that. I'll share more. Also, second, I got this cool shirt for everyone on my team. It says we should have more billionaires. It's awesome. I saw my doctor the other day for my annual checkup. He's a really kind individual, and he said we're talking about a couple of things, and then I was like, I'm not the biggest fan of Mamdani. Then he's like, but we need more redistribution. I was like, well, do you? Do you? Like, who's created more wealth for more Americans? Is it Ray Kroc from McDonald's? Who's created technology and innovation to drive up productivity and income? This isn't like an abstract thing. It's very real. In developing markets like India, for example, many middle-class families have servants that work for them at very low wages. You don't have that happen in the United States. It doesn't happen in the US. The reason why is because there's more capital in the US. That capital takes the form of machinery and equipment or training or job skills, which makes individuals productive. And that productivity means that employers can generate more revenue, they can generate more earnings, and that creates a bid for talent, creates a bid for the labor pool in a competitive market, which raises living standards. So these developing markets, they don't have enough capital. They don't have enough capitalism. The funny thing about capitalism, it's both the most unintuitive concept in the world and also highly intuitive, right? Unlike democracy, which is the least worst form of government, capitalism, I strongly believe, is the best way of organizing humans in a non-coercive, voluntary manner that channels people to compete to service others. If you want to create wealth, you got to service others. Ray Kroc built McDonald's. He serviced, well, $1 billion flipped. I think they stopped counting how many hamburgers the organization has flipped. And if you're a franchise owner, you created a lot of wealth. And if you weren't a franchise owner and you're a customer, you saved a lot of money versus alternatives. Okay. Now, maybe I don't go to McDonald's, but that's my choice, my prerogative. Who am I to deny someone else from doing that? Right. That's a public health, public education kind of conversation. That's a different conversation. So I also want to touch on a few things around earnings. Like, earnings hasn't been this strong in many quarters. Like 80% plus of companies are beating earnings. Okay. The fact that people still don't recognize that it's Goldilocks is bullish. Earnings are strong. Earnings are strong everywhere. Okay. So Trump is cutting trade deals with himself, I guess, or Japan and Europe. We talked about this before. He can just say, here's the deal. Here's the deal. Tariffs are a tax on American importers. So if you're Europe or Japan, you really don't care. You're just slow walking it. Okay. There's a 15% tariff rate on the European Union. Europe doesn't really care. It's not going to make much of a difference for them. So this is all theatrics. This is all just reality television, right? Like when Trump was touring the Federal Reserve with Jerome Powell. You can't make this up. What a week between that and Hunter Biden explaining the subtle differences between uh, crack and cocaine. I mean, I'm waiting for the simulation to end any moment now. But it's all just theatrics. It's all theatrics. I thought it was interesting to hear Treasury Secretary Bessent make the argument that you can lower rates, arguing that this is the late 90s again. He's invoking Alan Greenspan, who kept rates lower for longer, not higher for longer, but lower for longer, on the idea that there's greater productivity that's being ushered in from AI. That's actually a really good argument. There is higher productivity from AI. That's an interesting argument. Now, does he believe that, or is he trying to sugarcoat a policy objective? That I don't know. I still think rates are fine where they are. You got a strong economy. Boomers are spending. All that T-bill income is going back into the economy. And it's nice to be able to have a safety valve to cut rates when you really need to. A few other thoughts. Is this a junk stock rally? Sure it is, but it's an everything rally. They're quality businesses that are mispriced. They're going up in value. Norwegian Cruise Lines, I mentioned, is one of them. It still has like a 10 or 11 PE ratio. Abercrombie and Fitch has like a 10 times PE ratio with double-digit earnings growth. Are junk stocks going up? Sure, they are going up too. That's the function of animal spirits. They tend to rally around this time of year. The rallies tend to fizzle as well. Actually, now we're kind of near the tail end of that seasonally, but people are still off sides. You've got record earnings growth. Initial claims beat again and again and again. Retail sales beat and beat. Like I don't know what to say. Like, guys, like this is a naturally growing economy. You've got Congress spending like drunken sailors, increasing deficit. That's bullish. I wish they didn't do that, but it is bullish. I'd rather have a trend rate of growth that's also volatile, but still bullish. What else? Google, they reported they had 14% net income growth year over year and revenue growth. And that's despite a significant $1.4 billion charge to their earnings from antitrust related costs, which are going to be one time. So they have operating leverage. Their cloud business is growing 30% plus. Where is it growing? AI related services. And that's a story you could tell for Oracle and Amazon and Microsoft. So there is a return on spend on AI. There are folks out there on Twitter that are just kind of poo-pooing this and saying, hey, we're laying down fiber like we did in the dot-com era, and that there's overcapacity. The end of the dot-com era was marked by excessive valuations and earnings failing to meet heightened expectations. You don't have that now. The valuations aren't as bad as they were then. They aren't as bad as they were in 2021. Amazon's PE ratio in 2021 at the peak was over 100. Now it's in the mid 30s. You have the ability to go buy a world-class business like Google with a high teens PE ratio, or Taiwan Semiconductor, the high teens PE ratio. That's not a bubble. Are there pockets of excess? Absolutely. Costco's got 50 times earnings. It hasn't gone anywhere, by the way. While it's been at that level, valuation does matter. It hasn't gone anywhere. It's been flat for 6 months. So yeah, the pockets of excess. This is a stock picker's market. This is a mean-reversion market. Highly shorted stocks are rallying the most. So it's causing a lot of pain to hedge funds that are kind of trained to short these stocks. That'll end at some point, but it's not ending now. When I look through charts, I don't see why it would necessarily end in the short run either. Momentum attracts its own momentum. What else? Another conclusion I'll share with you is, blockchain is the balance sheet now. Blockchain is a new balance sheet. We're seeing this convergence of different trends, including tokenization and deregulation colliding. And a theme I've come back to again and again is how, you're seeing private credit firms like Apollo and KKR get their assets on chain. They're tokenizing them. They're providing yield to investors. They're now liquefying that, and they're creating tokens around them. So you have access to private credit with non-mark-to-market risk. They're looking like banks. Private credit's turning to banks. So a lot of different worlds are colliding. It's really interesting. And technology, tokenization, deregulation, Stablecoin Act, all that's enabling this. I think there's going to see a lot of transformation in the next few years. I met with a leading securitization attorney in Chicago and Sidley Austin. I'm going to see if I can get him on the show. But he shared that, the ABS markets are wide open. You're seeing esoteric asset classes seeking ratings on their non-rated debt. And insurance companies and private equity firms are taking on more risk. Banks are becoming originate to distribute machines. Insurance companies are taking the rated risk, the senior risk in a securitization capital stack, and then private equity is taking the junior tranches. That's interesting, just seeing the evolution of these banks. The idea that banks would be in the originate to distribute business would be kind of unthinkable coming out of the 2008 crisis or leading up to it. I mean, originate to distribute is this bad word that means you don't have skin in the game. You're just trying to create a product, get it off your balance sheet, and sell it to someone else. Okay. You had a lot of subprime mortgage originators like New Century Financial be in that business. So, but, I think those future challenges are not here today. Credit quality is fine. Real incomes are up. You have tax cuts coming for low-income Americans also. Animal spirits are high. Household balance sheets are strong. Stock markets are all-time high. Confidence is increasing and recovering. Earnings growth, as I mentioned, is high. People are confused because they keep looking at these Case-Shiller indices and say, hey, look at that number. It's really high. It's supposed to mean revert. The issue is this. It's a composition fallacy. So if you look inside the S&P 500 and QQQ, if you look at the weights on the different securities, you have more Mag 7 weighting, something like 35% plus or minus. And those are higher quality businesses that merit a higher multiple. That's why the aggregate index valuations look elevated. At the stock specific level, outside these pockets of excess, they don't look elevated. That's the thing. I just give you an example of Google, 20 times, Taiwan Semiconductor, 19 times forward earnings. Tesla is expensive. I mentioned that. It's been lagging. Okay, so that's an area of excess. Apple, I think, is overpriced. It's been lagging. So there are pockets there. But you have these rolling corrections too, like in healthcare. Healthcare is like cheap now, right? I saw an article that premiums are going to go up next year. Well, guess what? That means revenue goes up and free cash flow goes up and healthcare gets out of the bear market that it's been in. I don't know what more bad news healthcare can get at this point that not everyone has seen that's not priced in. So, I think, look, you still have a bull market and you've got psychology that doesn't recognize it as such, and you got people that are offsides. There's a lot of technology that's going to drive productivity growth for these mid caps and small caps and tech forward innovators. One of the other themes I come back to is this kind of a bifurcation or K-shaped economy. You're going to have the AI haves and the AI have-nots, and folks that are AI forward are going to do really, really well. My friend Paul Su from Decasonic, the VC conference that he hosted last Wednesday, he's talking about how he's got 15 AI agents per person and they're building org charts with AI. I think he's like ahead of the curve than most, but you are seeing those productivity gains, right? Goldman Sachs is accelerating their S1 process using AI technology. We're using it at Lumida all the time. Go to lumidaai.com. You can see some of the things we're doing there. Look at Lumida earnings. We just created that account. We have an AI that within 30 minutes of a transcript, it analyzes it, classifies the result as really good or really bad, builds a nice looking chart, publishes on Twitter, and then it dynamically adds it to a watch list. Then it calls another AI agent, which creates a bull bear case for it. And then someone, the CIO team, can assess that. So we're still in the phase of AIs driving productivity gains. We're not in the labor displacement phase. We're in the AIs driving productivity gains. So, the economy is transforming and productivity is increasing. But it's been a great time to be a stock picker because, again, if you can identify the AI haves versus the have-nots, I think you can do really well. If you're in management, you've got to be on the ball. You've got to be dynamic. You've got to refactor your business line and ask yourself, hey, can I do this with AI or not? Let's see. All right, I think we covered a lot of ground there. Here's a book. This is a classic book. I try to bring one book out from the bookshelf and share with you all here. This book is called Payment Systems in the United States. This is a classic primer that essentially anyone gets when they join the payments team of a bank or they join a fintech. This book is outdated now. This book is outdated because of stablecoin. That payment rail is not on this book. Stablecoins are instant, they're cheaper, they're cross-border, they're transparent. There's a ledger that's created, that's updated anytime they transact. And it's better than ACH and wires. So a lot of transformation ahead. Regulation unlocks new markets, creates winners and losers. This is a multi-year story. So there's time to consider its impacts. But we're going to have some top-notch VCs that I like and respect join the pod, perhaps the very next one later this week, actually. I have to double click and share more about this. Okay, what else? Anything else? Any questions? Hope you guys are well. This is a short and sweet one. I have to host a friend who's visiting from Philly today, so that'll be fun. My son scored a few goals in soccer. He has like an age and height advantage, to be fair, but it's helping him build his confidence. That's great. That's a win. No greater joy than seeing your kids win and achieve and get better, improve upon themselves. Something we should all do, right? With that, we'll call it a wrap. Make it a great rest of the weekend and make it a great week ahead. Be well now.